Good morning, welcome, and a huge thank you for joining the first of our webinars titled Conversations by PrimaryBid. Before we start, an important disclaimer. Please take the time to read our risk warning carefully. Remember that the value of investments can fall as well as rise, which could mean getting back less than you originally put in. Your capital is at risk. You should not interpret any opinions or views expressed on this webinar as a recommendation to make any investment or to take or not to take any actions or decisions in relation to any matter. Should you take any such action or decision based on information in the webinar, you do so entirely at your own risk. Now, whilst I leave you to read the rest of this, let me provide a bit of context around the webinar and our thoughts in the broader area of content. Over the last 18 months, we've made a bit of progress in facilitating access for individuals to transactions that they could not previously have taken part in. We've presented over 150 deals to private investors through our app and through our partnerships with leading stockbrokers and platforms, generating over $1 billion in demand. However, we know that we can do a lot more to generate ongoing connectivity and engagement between individuals and issuers. We think we've an important role to play in helping information flow in a format that is convenient and with a voice that speaks with clarity and without jargon. We will seek to do this both at the time of transaction, where we are increasingly producing our own content to supplement required regulatory documents, and on an ongoing basis so that individual shareholders understand how the companies that they have funded are using their capital and delivering on strategic objectives previously outlined to their investors. With that to set the scene, let's move on to the main event. So why have we brought these companies together today? Investopedia defines venture capital as a form of private equity that investors provide to startup companies and small businesses that are believed to have long-term growth potential. Fair enough. I think we can agree on that. But the next line interested me. Venture capital generally comes from well-off investors, investment banks, and any other financial institutions. That felt a bit out of date, evidenced by the speakers that we have here today. What these companies are doing aligns very well with the ethos of PrimaryBid, the provision of investment opportunities to individuals that they were previously unable to access. Augmentum, Draper Esprit, and Forward Partners all offer exposure to privately held early stage technology investments through liquid listed vehicles. All have generated strong returns historically, with gross internal rates of return of over 20%, evidenced of course further by the trading statement released by Draper this morning. However, each has a different focus and secret sauce. We wanted to provide a platform for these companies to explain their process, their competitive advantage, why it should be sustainable, and to bring the investment alive by reference to portfolio companies. We feel incredibly fortunate to have Tim, Ben, and Nick with us today. First, I'll provide some background on the industry before handing over to our speakers. We'll leave time at the end for questions. Do please submit these using the chat box on your screen. So why might venture capital form part of a diversified investment portfolio? The first reason, and probably the most straightforward, is performance. Venture capital has generated strong returns. Data from Cambridge Associates shows that their US venture capital index has outperformed both the MSCI World and NASDAQ over 1, 3, 5, 10, and 15 years. Capital formation is increasingly done in private markets. VC fundraising has grown significantly, and the capital allocated to private assets has grown threefold in the past decade to 7.4 trillion, according to Morgan Stanley. It's becoming too big to ignore, perhaps. Companies are increasingly reaching greater levels of maturity before they choose a public listing. Now, this may reflect the lower capital requirements of scalable technology businesses, which of course has driven this well-known phenomenon of unicorns. Today, it's harder to find high potential early stage businesses on public markets. Klarna's a great example of this, founded 16 long years ago and with a value at its last funding round of over $30 billion. This value, in market capitalization terms, would place Klarna in the FTSE 30, above Tesco, and with a value 50% greater than that of Standard Chartered Bank. And finally, diversification. Whilst early stage companies are typically higher risk, investing in funds that have a portfolio of startups allows investors to play the average. So having spoken briefly about why venture capital might be interesting, why listed venture capital? First, there's the ease of access. As Investopedia reports, individuals have previously found it hard to gain entry to these potentially lucrative opportunities. Funds have often been unlisted vehicles with high minimum investment hurdles, targeted solely at institutions and wealthy individuals. Listed venture capital changes this. Secondly, liquidity. Venture capital investments are often illiquid. They have long holding periods, requiring capital to be tied up for a number of years linked to the life of the fund. Listed venture capital can be traded daily, depending on the volume of the stock. In contrast to traditional limited life fund structures, venture funds that raise money in public markets have access to permanent capital and therefore greater flexibility in managing their investments. And there's certainly something around network and brand. Although venture capital has delivered strong results in aggregate, the best results have been concentrated in a relatively small number of managers. Certainly, the value of brand and reputation can be hugely important in sourcing deals, and a public list arguably helps this. The final point is that venture capital is no longer a US phenomenon. It's not just about Silicon Valley anymore. The UK and European VC industry has seen incredible growth over the last decade, with the UK particularly vibrant, as you can see in this chart. As a result, all of the companies presenting today have a rich opportunity set, translating into a strong pipeline. That's all I was going to say by way of introduction. And with that, let me hand over to the first of our speakers, Tim Levine of Augmentum. Tim, welcome.
Thank you, Nick, and good morning, everyone, and delighted to be here. And you've done a great job of selling the vision of venture. So I guess really for me, it's to talk about less about the asset class, more about the opportunity in fintech. And I think the change that we've certainly seen, we've listed about 3.5 years ago, and I would say, over the last 12 to 18 months in particular, you are starting to see a real sea change. We talk less about whether fintech is real. I think it is substantive and growing. But the adoption, the attitudinal shift from the incumbents in particular, I think is reflected with some of the rhetoric that we've heard. And, JP Morgan and Jamie Dimon, one of the most vocal, is certainly kind of shifted not only their rhetoric, but their approach, the level of investment as well. And you only need to look at their recent acquisition of Nutmeg as one example of the type of behavior that we'll certainly see from the incumbents over the coming years. And when we look at what has driven that shift, there's no question that COVID has driven that acceleration in digital adoption, and it's not something that's exclusive to fintech. But fintech and financial services in particular was a real laggard. I think when you start to transpose the penetration of digitization in financial services relative to other industries, we were very much behind the curve. And that digital adoption and that acceleration over the past 18 months in particular, you're starting to see really flow through. And we've seen that throughout 2020. I'm quite interested to see how those numbers evolve over 21. Certainly, the underlying trends in the portfolio still very much are showing that customer cohort that was proving really stubborn to acquire over the past kind of 3 or 4 years has not only transferred across to digital adoption, but are remaining quite sticky and recognizing the significant benefits that it brings. And I think when you look at the opportunity ahead, yes, we've seen a seismic shift in adoption, but the opportunity ahead is still significant. There is still a long way to go. Hence the reason you are seeing the asset class attract such significant capital at the current time. But over the next 5+ years, you're going to continue to see that capital flow through to the industry in our view. And Nick quite helpfully put some different data, but delivering the same message in terms of kind of venture capital as an asset class outperforming the public markets. I think as importantly, when we kind of dig down and why specialize in fintech, one, because it's one of the largest sectors. Two, in terms of penetration, it was 3-4 years ago sub 10%, and in terms of performance, and we expect this to continue, it's been arguably the best performing sector within venture capital as well. And again, it's our expectation that it will continue to be the best, if not one of the best, over the coming 10 years. And it is a complicated, varied asset class. But I think the one thing that we've certainly recognised, and when I go back 20 years when we started Flutter, which became Betfair, it was very tough for entrepreneurs to raise venture capital. There has been a total shift. It has never been a better time to be a tech entrepreneur in the UK and Europe. And so, there is an argument amongst some that capital has been become somewhat of a commodity. And I think differentiation is incredibly important. So, why permanent capital? Because it certainly has some key advantages, as Nick alluded to it earlier. Two, very few venture funds have that sole focus on fintech. And I think certain entrepreneurs, and not all, they want to see that operational entrepreneurial DNA within the venture fund as well, that experience that can resonate. And I think for us, we are very much a team that has had that operational entrepreneurial DNA, having built multi-billion-dollar tech businesses as well, and transferring some of that learning across to the investment side as well. And as I said, I think that story certainly resonates with some. It's not the be all and end all, but it's an important feature. That's something we need to continue to leverage as well in what is becoming an increasingly competitive market, despite the depth of opportunity that is out there. And I think just talking for a couple of minutes about Augmentum specifically and the portfolio that we've tried to build. What was really important for us 3.5 years ago was, one, to articulate the opportunity, the potential of the asset class. But what we didn't have was that diversified portfolio across a number of sectors that we felt held the greatest potential in the UK and continental Europe. And I think roll forward 3 years, what we have now is a really well-balanced portfolio where we've attacked those sectors that we're starting to see some very encouraging signs of disruption, others that are more mature, and really ensuring we've got that balance, whether it's across the B2B side and the B2C side, and then really providing to both our retail and institutional investors that diversified exposure to 24 companies currently in the portfolio. And I think what's really important for a listed fund, and certainly part of our strategy, is to provide that diversification, not just by subsector, but by stage as well. And I think the beauty of the permanent capital vehicle is it allows you to be patient. Yes, we want to have a portfolio of high potential, exciting early businesses, but at the same time, we recognize that investors are looking for tangible growth, tangible proof of concept, businesses that have demonstrated a path to profitability, that are on that path to exit and will deliver tangible realizations in the shorter term, rather than waiting for 7, 8, 9 years. And I think you've got to kind of have that balance. And I think for us, we've started to demonstrate. Our friends at Draper are a few years, longer in the journey than us, and have started to see that come through. And we would expect over the next 2 years to see some of those realizations start to flow through that allow you to continue to invest and support, and certainly give belief amongst your investor base that some of these earlier bets you can continue to support and invest on their journey, and hopefully some of them come through and really deliver those outsized returns. Of course, we all hope for the Klarna story, and it's been a fantastic case, and there are multiple cases on similar lines in the fintech, and I think we are going to see more and more of those stories develop, both within fintech and beyond over the coming years. But for us, it is a question of making sure that you've got that balanced portfolio construction. In a crude way, how you should think about it is, we want the weight of number of companies towards the majority to be towards the earlier stage, but the weight of our NAV to be towards a later stage. And what we would define late is businesses that can deliver a plausible return through a M&A, through a IPO within kind of 2 years. And that's certainly how we're looking to develop our portfolio construction. And just finally, the one thing I would like to deliver in terms of messaging is that, yes, we hear of lots of overnight success stories. They tend to be the exception rather than the rule. Helping build a multi-billion-dollar business from the early stages takes time, and it's not a straight line up. There are plenty of pitfalls along the way, and I think using the example of Interactive Investor, which was, to be honest, at the time in which we invested, it was a little bit of a contrarian bet. It was a business that could have been perceived as a digital dinosaur. There was a lot of venture money going into the robo-advisory space. We felt that the unit economics were more interesting in the self-directed space. And at the point in which we originally invested, it was managing about $1.5 billion of assets. Today, it's north of 55 billion, and has publicly talked about its ambitions in the next year or so to IPO. But these are journeys where real value-added venture funds, one, will be patient, two, will recognize the path that they need to go on, really help them along that journey, but also recognize the role that you need to play. I think I'll pause there and move on to Ben, which I think is next.
That's exactly right. Thank you, Tim. And just a very, very quick reminder for those viewing, please do input your questions. We'll get to them at the end. We've had some great ones so far, but do please keep them coming. Ben, it's all yours. Thank you.
Super. Thank you very much. And thank you for the introduction to venture capital, and also to Tim for outlining the fintech subsector of venture capital. I actually look at Draper Esprit as a vehicle which has now scaled and is liquid in the market, and is really giving investors the opportunity to access venture capital across Europe as an asset class in its own right, and therefore it's almost an asset allocation investment decision. As has already been outlined, it gives people the ability to access it through liquid vehicles, so you can get daily trading volumes, and anybody can buy the shares. And I think that's a key feature of the market, which is important to all three of the speakers today. For Draper Esprit to make that work, what we're trying to do is therefore create this platform of opportunities. And what I'll walk you through now is outlining how, by investing across Europe and in the slightly later stages of investing, when we have some of those proof points that come through, we've been able to grow our balance sheet and the returns that come for investors, and develop this broad portfolio of existing assets. And I think that's one of the other key features of the models we're outlining today, is that when you buy a share, you're buying a share of everything day one. So you're getting all of the existing portfolios and the high growth that's attributed to those companies on the first day. Whereas if you were going into private structures, you would only really have the opportunity to go into the assets that the managers would be bringing in to those structures new and fresh, and so you wouldn't necessarily know the businesses on day one. Maybe if I just start skipping through some of these slides. I don't know if I can do that. Let's try. Here we go. Another disclaimer for everybody. So I think this slide really captures how we approach it. We've got a very traditional venture capital funnel on the left-hand side, which is lots of deals coming in at the top. The funneling through the investment team and the platform team brings down to what we actually put our money to work in each year. And we'll invest in roughly 10 to 15 new companies every year. And then we've also got a portfolio of 70 assets that create follow-on investment opportunities. And it's the ability to back these companies as they grow and scale and stay with them for longer, which is a key feature of our model. On the right-hand side, we show how we address the market and how we create this platform. We're not a seed fund, a seed investor directly into the assets, but what we do is invest through seed funds. I'll come on to that in a bit more detail in another slide. And then in terms of our primary investment vehicle, we first start to put capital to work at what we term the Series A, which is the sort of up to 10 million investment check sizes. And then the majority of our capital, at least 70% plus, is going into that later stage B and C investments. And then we can hold those assets through to IPO. We've got examples of doing that with Trustpilot and UiPath and also Kazoo just in the last year. The other thing probably to mention here is that we also partner with a firm across Europe, Earlybird, who are in Germany, so they have on-the-ground access at the Series A stage in the German-speaking region, and that really just broadens out this platform that I mentioned in terms of our ability to source and see high-quality deals across the European landscape. So just to give a little bit more colour on that seed fund investments that I mentioned, we now have a portfolio of about 40 plus seed funds across Europe that we invest in, including forward partners who you'll hear from Nick. And the reason why we do this is recognising that it's a differentiated skill set from where the stage of the market where we're investing, but also recognising that to get access to the best companies, you need to have an early look at them and an early visibility. And there's also subsectors and themes that come up as new areas over time, and it gives us the ability to have the expertise in those areas quickly. An example of those would be agri-tech or crypto funds, for example, or even specific quantum funds. So the seed fund program gives us those subsector thematics. It gives us access to companies, but it also gives us geographical presence. And you can see here the distribution of the seed funds is right across Europe. All of that broad platform, be that seed funds, deal flow, be that our own networks and our investment machine, allows us to deploy capital. And this chart is showing how we've scaled that deployment over time. We've put to work just last year 128 million in the year, which was up on the 90 million in the year before that. And actually this morning we put out a trading update saying that the investment for this first 6 months of this year has been 165 million. And what we're doing is really retaining the same number of deals. So we're still investing in a similar number of companies, but we're able to back those companies by being a lead investor, writing the larger check and making sure that we have a higher degree of influence and control and the right level of equity in those businesses as they scale. And it also means that we can put more money to work in our businesses and hold the winning companies, the growth companies, for longer. And on the left-hand side here, you'll see that balance of early versus late, it's really skewed towards that growth stage, that later stage investments as we get the proof points in those businesses. On the next slide, it's really just characterizing the same where the deployment of that 128 million has gone. And I think the thing to take away here is really just the breadth of what we can access. We, as I mentioned, are investing right across Europe, but we're investing across 4 broad areas. So although we will cover fintech, and that's probably about 25% of our portfolio, the areas that we tend to characterize these businesses in are enterprise, as in selling to companies, and that's usually software businesses and with SaaS recurring revenues. We'll also invest in consumer businesses, and some of the fintechs like Revolut and N26 we would consider as consumer, because consumer is the end user of the product. And then we will also have deep tech and hardware, which can be silicon chips, can be material science, and also the final area we invest across is digital health. And so there's really a breadth of what we're able to provide. It's a much wider set of companies, but they're all underpinned by technology. They're all tech investments, and that's really where we anchor ourselves to. So I'll touch here on cash realizations. I think the key in particularly in public markets where you're valuing your businesses through the cycles is to recognize that the two important points of any investment are the day you make your investment and the price you get in at, and ultimately the day that you exit. And everything in between is reflecting where the journey is. And for a public market investor, having the cash realizations coming back is a key feature of the model, because it really proves the valuation marks and it proves the underlying valuation of the portfolio, but also it shows that we can return capital back to the PLC that can be recycled into new investments as well. And so that return of capital has been a key feature in terms of helping investors understand our model and get those proof points on the journey, but it's also a feature of liquidity for ourselves. And we've been pleased to be able to demonstrate over 300 million of capital returned back over the 5 years that we've been public, and further updated today with another 67 million of capital returned over the last 6 months. And really that's allowing us to scale our investments, as I've just outlined, but it's also meant that as we grow the balance sheet, we're now around the 1.4 billion in size, which I think for the public markets is important as a benchmark for liquidity and scale to access this as an asset class. And then here I'm just outlining some of the portfolio, so you get a bit of a sense of how it categorizes across those 4 areas, and also how it's scaled over the last few years. Again, it's really a reflection of the different types of companies and geographies that we have access to, but we're really honing those down into the best opportunities. And it's the portfolio management, some degree to which Tim touched on, that is an important factor, and really where you get your value from the manager and the investment team is managing this portfolio so that you put more capital into your companies that are doing well, but you also make sure that those companies that aren't scaling in the way you initially thought they were get moved on and out of the portfolio. And these companies, even if they're not growing quickly and ones that would fit in the category of companies we want to put more capital to work with, will still have inherent underlying IP and be valuable to somebody. In venture capital, you're really looking for those high growth businesses. And finally, I'll just probably touch on ESG. It's a very important part of what we do, but it's also very important for the public market investors to see how we're achieving our own goals with this. And what we've done here is to map the portfolio against UN Sustainable Development Goals, and we have about 70% of the portfolio is reaching at least one of these goals. And going forward, we continue to work with the portfolio so that they're also on their own ESG journey, and making sure that as we have companies that create the future and are very inventive, that we're creating a future that's fair and sustainable and available to all. So I think at that, I will hand over to Nick, who can give you an overview on Forward Partners.
Thanks, Ben. And this is one Nick handing over to another Nick. Last but not least, Forward Partners. Thank you.
Thank you, Nick, and hello, everybody. Thank you for tuning in. Over 250 of you here, which is great to see. So we've heard a lot from first from Nick and then from Tim and Ben about the venture capital model. What I'm going to focus on here is really what's different about Forward. We are, the core of our business is most definitely venture capital, but we do it in some quite different ways. But first, a quick intro to me. So Nick Brisbane, founder, CEO of Forward. Been in this game since 1999, so over 20 years now, and I got the tail end of the internet bubble. I had 4 or 5 months of really exciting fun times, and then spent years and years picking up the pieces. And by the mid noughties, I was joking that my career in the venture capital industry had been 10% fun and 90% pain. But things have really picked up in this market, as we've seen from some of the earlier talks. Really since 2007, and it's a super exciting market to be in, high growth, high profits now. And so 20 years in this industry, kind of the most notable stint prior to founding Forward in 2013 was as a founding partner at Draper Esprit. my old shop, Ben's current place. So at Forward, we think about our role from when I think about it from an investor perspective. Our role, the job we do for you as investors, if you like, is we give access. We give access to the startup ecosystem, which is very fast growing, and we do that in the fastest growing part of that ecosystem, which is in Europe, and which is here in the UK, and a large chunk of that is really here in London. And we're very early stage investors, so a step earlier than Draper, and Augmentum. That's why we're part of the seed program at Draper. And I've said it before, but I'll say it again. Thank you to Ben and the folks there for backing us in our IPO, indeed, alongside many of you at PrimaryBid. So we're very early stage investors, so pre-seed and seed stage, and we're excited by that part of the market because that's where you can really get the very fastest growth in companies, and therefore we can drive fast growth in our NAV. And so at pre-seed and seed, we focus on the hottest sectors, so applied AI, marketplaces, e-commerce, and then last year, alongside our venture capital offering, we launched a revenue-based finance offering for early stage companies as well, and I'll talk a little bit more about that in a second. And so finding those companies, delivering that access to investors, that's difficult, challenging work. We need to attract a lot of deal flow. So we see over 4,000 deals a year, and then it's a lot of work processing that and a lot of skill really choosing the best ones. So we meet over 400 of those companies, and we end up investing in 5 to 10 a year. So that's between sort of 0.1 to 0.2% of our deal flow. And then the final point I want to draw out here from the left-hand side of this slide is that we work really hard to supercharge the growth of our companies, and we do that by being great board directors in the manner of all other good VC firms. But in addition, we have, and this is one of the unique things about Forward, we have what we call our studio team. That's an agency which we operate exclusively on behalf of our portfolio companies that helps them with growth, with recruitment, with development, with brand and design. And I'll talk more about that on the next slide. And in the 8 years we've been going, we have now 45 active companies in the portfolio. There's just a selection of them here on the right, but really pleased, really proud of the way that's growing. And to draw a couple of examples here. So Kazoo is on a path, and Ben mentioned them briefly, they're investors too, on a path to becoming the kind of new dominant player in second-hand car sales right across Europe, and IPO'd earlier this year. And then the other big value driver for us so far this year has been Ably. They provide software for the real-time internet, and as you might have noticed, everybody wants things faster and faster and faster. It's part of the modern condition, isn't it? And Ably provides the infrastructure for that to happen over the internet. So I think notifications on your phone arriving quicker and quicker after the actual news events, and so billions, hundreds of billions of messages to 50 million plus endpoints per year. They're sending some complicated software right in the sweet spot of a nice growth market. So returning to the studio team, so Cluster Market is a company that we invested in earlier this year. It's a three-sided marketplace actually. So they make software for scientists, for researchers to access the machines they use for their research. So we have on the one side scientists, and on the other side these machines, think centrifuges, things like that. And the software allows them to book and reserve time on these machines, which amazingly in this day and age still happens 60% with a clipboard and a bit of paper and a pen on top of the machine. And then the third side of the marketplace is the people who buy the data that it throws off, and they are the machine manufacturers who can use that. At the moment, they just don't know who uses their machines. With the data, they can use that to sell preventative maintenance and consumables. So big market opportunity, fast growth business. The main reason I highlight it here is that they're a really good example of how the studio team works for us. And so cluster market, they chose us in part because they wanted to work with my partner Luke as their board director, but in part, and the CEO's on record as saying, I chose Forward Partners because I wanted to work with the studio team, and specifically wanted to do a project with us to think about the positioning and the way that they describe their product. And so fairly quickly, like 3 weeks, we worked with them to think about the copy they used to describe the product and the visual presentation. And that's transformed it. It's, like a big step up. It's become much simpler, much easier for customers to understand, and they've seen some great results from that. And you can see here on the quote from Tobias, one of the founders, and he describes what we do for a lot of our portfolio companies, because we've got deep now experience working with 65 companies over 8 years, deep experience of what makes startups work well. We're able to inject that confidence and give companies a real boost in their execution and drive their growth. And so there, when we have the two sides of the benefit from the studio team, it helps us win deals, and then it improves our returns once we're invested. And this is just a quick snapshot of our results. See, this slide seems to have turned upside down, but we enjoyed a very good 2021 so far, and as you can see, the big drivers of valuation growth in the first half were Kazoo and Ably that I mentioned before. And then since IPO, you might have seen we announced 3 exits. So firstly is the Kazoo IPO, which is a nice return for us, but I particularly want to call out the Wonderbly exit. It's a beautiful product, direct-to-consumer e-commerce business. They make children's books that are a delight to work with. Their mission as a company is to make children happy, curious, and clever. And to do that, they make these amazing books. Been the best-selling children's picture book in the UK for a number of years, and that encourages children to read. And super lovely team as well. So very pleased to see them get that away so well. And then in my final slide here, I want to illustrate how the different parts of Forward come together to give us what we believe is a really powerful engine for growth and success going forward. So every successful, I should say, venture capital business, and I would definitely count Augmentum and Draper in that list, operates a flywheel. You attract some good investments. That helps you to build a good portfolio, drives great returns. Your brand starts to get strong because everyone can see you're doing a good job. That means the next generation of entrepreneurs are more inclined to work with you. And so it circles round and round and round. That's where you get a persistence effect in venture as an asset class that you don't see in many other forms of investment. So we have that going on in ventures. And then we have the same cycle goes on in Forward Advances, our new debt business. Again, as that business grows, we build a reputation for making wise investments, get good returns, treat our customers well. The next customer acquisition becomes easier, and so it cycles round and round. But what's beautiful about having the two of them in the same company, Advances and Ventures, is that the two cycles interact. They're mutually accelerating. And so, for example, through Advances, we touch have many more customers than we do on the venture side. It's much more of a scale game. And so we've made over 100 advances in 18 months compared to 65 odd investments in 8 years on the venture side. And referrals are the best source of deal flow in ventures. And so our base of customers to provide those referrals is just growing like orders of magnitude faster than it ever would have done before. And on the other side, companies choose us to take advances over our competitors because they like the fact that we're a venture capital brand too. They have aspirations one day to raise venture capital themselves, many of them. And so there's good brand synergies, great balance sheet synergies, great information synergies. So the two really are mutually reinforcing. And then finally, we have the studio team that sits in the middle, our accelerating both of those flywheels. So we first drew a version. It's one of our investors when we first got started in 2013. Drew this flywheel without advances at that point and said, look, what's magic about what you're doing here, Nick, is that the studio team accelerates your progress around that flywheel, will enable you to build a big successful brand and venture more quickly than you otherwise would, because it kickstarts our brand, it makes us more attractive immediately, and accelerates the growth of their companies, and so everything just moves faster and faster around. So what we've tried to construct here is a really, what we hope is a very elegant model to drive very rapid growth in what's already an exciting market, and well, that's why we're confident about the future for Forward Partners. Hopefully a compelling model, and one, as we've heard a number of times today, is a really exciting market to be part of. And that I will hand over back to Nick, I guess, to drive some questions.
Thank you, and let me invite all of the other speakers back. Welcome, and thank you for the insights that you've all given to your businesses. It's really, really helpful. For the time that we've got left, let's move to Q&A. There's one I'd like to start with, but we do have a lot from the floor, and I thought I'd start because it was very topical. It came from the FT last week, I think, and the quote is, "There is now so much money being chucked at private markets that it seems overwhelmingly likely that returns for everyone will soften in the coming years, even for the industry's rock stars." So recognizing that you may be the industry's rock stars, how do you ensure price discipline in a market which clearly is very, very hot? Who'd like to take that one?
Well, that's a tasty one to kick off. I mean, I'm interested to hear my Ben and Nick's views too. I mean, I think there's no question that we are seeing more capital come into the asset class than ever before. I think, I would characterize our role to provide alpha, and I think you're seeing a lot of capital come in that simply is going to provide beta. And I think you've got to look at the returns over time in a more granular way. And at the end of the day, our job is to access very hard to access propositions, the very best entrepreneurs in the fintech space across Europe, and get there before some of these, larger funds come in, that are coming to the market, arguably for the first time, of strong conviction about, in our world, fintech as an asset class, but are trying to build almost an immediate portfolio. So I still think you will see differentiation, and depends on how you define rock stars. Frankly, from our point of view, it's still investing on fundamentals. We've said no to more opportunities this year than ever before. We've lost more deals this year than the previous 10 years combined through not being willing to pay the price. Ultimately, if we can't see the return, then we're not going to step in. Yes, if we have conviction, then we will go in. What we do have to do, and what we have had to adjust, is move much quicker. And I'm sure that's the same for Draper and Forward. Execution at pace is key. So I don't think it's changed our approach or our strategy, but ultimately, as long as you can maintain that discipline, and when you do have conviction, then you have to move that bit quicker, and you have to, comes back to my previous point, you have to differentiate and articulate why your capital is more attractive than other sources of capital. And I think we are seeing a lot of tourist money in this space. Some of it will remain, a lot of it will go away, but ultimately, we still see very strong long-term opportunity in European and fintech and beyond. And I think there's a lot of opportunity still ahead.
Thanks, Tim. Ben, Nick, there's clearly something there around both discipline and around speed. Presumably, there's something too around the infrastructure that you have of offering more than just capital, which must be very attractive to any kind of entrepreneur. And that's a question that links rather nicely, but it comes from Adam.
So maybe I'll jump in if that's all right, Ben. So discipline, Tim mentioned it, you're absolutely right, Nick.
Well, I think Nick might have lost some of his reception there. But maybe I'll fill the gap. And
this is your chance to jump in.
Yeah, I promise I didn't do anything to sabotage him. I think touching on the points of the market, I see that the market has grown substantially, but we're still a third the size of the US. So I think there's further to go. I also look at, if you sort of bifurcate where the capital is being deployed, a lot of it's at the 100 million plus rounds. And all of us here are actually investing earlier than that. To Tim's point, it's about finding good investments. It's keeping that discipline and then getting into those deals. One thing that we've been able to do to differentiate ourselves is to, and actually this is a point worth making, you do have to sell yourself into these businesses. You don't turn up with the capital and write the check and thanks for coming. This is a process where you've got to show the value that you add to those companies and to those entrepreneurs. And being able to point to our track record is very important in that, and particularly scaling companies into new markets. But what's also become increasingly true for us is our ability to lead deals with the right size of investment capital that we can put in. That helps us speak to entrepreneurs in advance. It helps us to be able to talk to them about the pricing of their round, and then to lead that round and help them to form the syndicate around the investment. So I think that the size of the check has become important, but also, as Tim outlined, that speed of execution. But it's still absolutely true. You've got to prove your value to the entrepreneur along the journey, and quite often new capital coming into the space just isn't able to do that. I think in the case of all of us here, we're active managers where you sit on the boards of those companies and you help them build and you help those entrepreneurs to realize the potential of the investment and the opportunity. And a lot of the capital that's coming into the space is investing at the later stage, and it's more akin then to perhaps similar to a public market type of investing where you don't necessarily take the board access. So I think you need to look at everything in context, but I think there's another underpinning of context here as well, which is, yes, round sizes are getting more expensive, but the pace of disruption across Europe has increased and the opportunity set has also increased. And I mean that from the types of deals that we see, but also the outcomes. UiPath is a good example in our portfolio that listed for over 30 billion. Revolut has moved up to over a 30 billion valuation. You mentioned Klarna earlier. We weren't seeing those in Europe even 3-4 years ago. The status of a unicorn being a $1 billion valuation was seen as rare. Now it's commonplace. It's almost if you're not a unicorn, what are you? To some degree, it's become quite different. But what I think that points to is the opportunity and the outcome. So yes, although the round sizes are increasing, I actually think the returns will increase because of that opportunity set.
Yeah, and I think just building on that, Nick, what the criticism to European venture, even as not that long ago, 4 or 5 years ago, was that European founders and entrepreneurs were selling too soon and we weren't building enough unicorn. And I think that was a rather snobbish view, in particular, that came from North America. And you didn't see a lot of these North American funds investing in Europe. They bypassed Europe and said, well, we lost a lot of money in the early noughties and we'll go to Asia. And I think as a result of some of the extraordinary businesses that are starting to kind of come through and have been built and will be built over the next few years, you are now seeing a totally different view. You are seeing these large North American funds, hedge funds, endowments. You're seeing sovereign wealth come into this market for the first time. And I think this comes to one's pedigree and reputation in the market. If you have zero exposure to European fintech or European venture, the only selling point you have is your money and the price you're willing to pay. When you have a strong track record and a long history and a pedigree, you can be more selective. And I think we are seeing that bifurcating of the market, where you've got those that are looking to immediately build from scratch a very significant portfolio because they have huge assets at their disposal and they want a European venture portfolio that they've ignored for the last 10 years. And I think that's where you really need to segment the market. And I think arguably in some of those cases, yes, you will see a pretty disappointing cohort of returns for 2021 and beyond. But I still believe those specialists, those that have got deep pedigree and history in this market, can still deliver outsized returns. And certainly that's our strong thesis in the European fintech market.
Thank you, Tim. Let me move on to a question from Oliver. I'll invite Nick back if his internet chooses to work again. But whilst we're here, a question from Oliver around whether stated returns take into account the high failure rates of venture capital? And I guess that the wider question here is about distribution. What is a reasonable hit rate? How's that maybe changed with this idea that when you win, then you win big now because of this unicorn concept? Ben, why don't we start with you?
Yeah, I think it's worth pointing out that the return stats that everyone talks to are the aggregate. It's not taking just the winners, if you like, and so you're blending everything together. The venture capital as an asset class has been proven. You had a stat right at the start, but for example, over the last 40 years, I think it's performed net of fees at a 17% return, which is above public markets at an 11% return. So that has been proven, and for us, because we invest slightly later stage, we'll have a slightly different profile than a seed investment business will do. We have more proof points at the time of putting the capital to work, and therefore what we tend to see is, if we invest in 10 companies, you'll have 3 to 4 that will be the big returners, and then will ultimately drive the fund returns. And then you'll have perhaps 1 in 10 that doesn't bring you any capital back. But that middle cohort is where you really make your value as a manager, because you're selling those businesses on. And we structure our investments so that we're in the preferred shares. And what that means is, when you put your capital into the business, at the point of an exit, you're the first capital out. So actually you have a lot of downside protection from the point of investing in these companies. The value can fall a long way before you actually start to lose any capital. And therefore, at the point of an exit, we will probably get some degree of less than 1x return for some of our investments, but up to a 2x even on that middle cohort. But what is also true is that because of the portfolio approach you have, you put more money into your winners over time, and therefore you're doubling down on those returns. And because you're allocating your capital in that way, even if you are losing your initial investment in one case and you're getting up to 2x returns in the middle case, it's still your 3 to 4 out of 10 that really drive your performance and make the difference.
Got it. Tim?
Not much more to add. I think Ben encapsulated it pretty well, and obviously we follow a similar format. I think really the key takeaway, for investors looking at the asset class, of course, there is risk. Hence the reason you need that diversification, and you need to look across the portfolio. And I think the beauty of the permanent capital structure allows you to, one, be patient where you need to be, but also to be opportunistic even later in that journey as well, which traditional venture will typically often focus on a particular stage. So the failure rates of will really differ depending on the stage. Seed, Series A, Series B, Series C all have very different failure rates, but again, we'll have the outlast success stories will have different return profiles too. So yeah, I think it's the necessity of diversification, hence the reason that I think when you look at venture funds, you want to make sure that you've got that diversification, and you feel confident that there is enough variety in there and enough early signs of potential big winners that give you confidence to invest for the longer term.
Yeah, and I certainly heard 2 interesting things there, both around structuring the investment in terms of where you sit within the capital stack, and also the dynamism around a portfolio management, which maybe I don't necessarily think about venture, which is an interesting feature too. A question from Ed, who says, how do you see blockchain technology disrupting the VC space? So this is about disintermediation and the idea that owning tokens or coins of an investment of a company, and how this might disrupt your ability to participate.
Maybe I'll go first if you don't mind. So for me, I think any technology can disrupt markets, and particularly blockchain is one that can possibly disrupt quite a few industries. I think one feature of venture capital, which is crucial, is that it's very network driven, and it's network driven when you due diligence an investment, when you find an investment, and through the journey. And the feature of venture capital is also that you syndicate risk. And what I mean by that is we will hold, for example, a 10 to 20% equity stake in an investment, but then we would also have 3 or 4 other venture capital firms or private equity partners around the table holding similar stakes. And so you're competing for deals, but you're also partners. And that's quite a strong feature of the market. And I think that keeps the bar for quality high as well. So I think the disintermediation point, it can happen to certain sections of the market, particularly where people would like to actively trade their investments as a secondary holding. And I think that will be an interesting feature that will probably add more liquidity into what is currently an illiquid space. But I think in terms of the stages where we invest, I don't see that you can disintermediate in the same way with a blockchain technology. I think it's still very much people driven.
Thanks, Ben. Tim?
Yeah, I think that's right. I mean, I think ultimately venture capital has seen little disruption over the past 40 years, and the likes of Draper and ourselves and Forward are, coming with a very different approach with the model that we've had. And it doesn't mean there'll be other models that come through, but ultimately it is about, what are you trying to do? If it's just about the capital, then perhaps there are other forms and alternatives that will be out there. But we see it amongst many of our portfolio where it's not just about, people aren't attracted necessarily to our structure. They're attracted to one. They're looking at the portfolio. They're looking at the history. They're looking at the cross collaboration. They're looking at our ability to kind of help leverage value, help them scale, and that's really where the value is. It's not necessarily about the structure. So I think we'll see lots of innovation in different structures in venture and private equity over the next few years, and blockchain might well be one of them. But I don't think it poses an existential risk. I just think it's another route that companies will be able to look to.
Great. Maybe we've got time for one more. We have a question from James, which is, what is the most unique company in your portfolio? And I can imagine this is a bit like choosing your favorite child, but mine's the dog. So what do you think? The most unique company?
Gosh, yeah, depends which day of the week you which is your favorite portfolio. I mean, I wouldn't say there's one particularly unique, but I might just point to a business that perhaps at face value isn't an obvious fintech story. So I'll talk about a business called Farewell, which is disrupting one of the oldest and possibly most unfashionable industries of death, the world of wills and probate and funerals. And you might ask, well, how would you define that as a fintech business? But ultimately, death is the most significant financial event of one's life. And, ultimately everything that goes around that, whether it's probate, whether it's the execution of the will, and the surrounding financial services products of life insurance and funeral plans are all kind of a core part of that. So I think, again, for me, that's a really hard subject to tackle, one in which perhaps on face value isn't one that, 25-year-olds are sitting thinking about disrupting, but it's an amazingly talented, dynamic and young team, all recognizing the huge pitfalls and the huge cost associated with both, one creating will, but when somebody in one's family passes away, the added stress of navigating that financial journey is expensive and painful. And I think for me, I really hope they're on a great path. There's a long way to go, but I think that's a great example of a team doing something really different and disrupting the industry for the better.
Interesting. That's not the answer that I was expecting, but it was a very good one. Ben.
Yeah, it's always a perennially difficult question, particularly as we have a large and broad portfolio, and as a venture investor, you're looking for disruption to markets and massive potential upside. And so I could pick businesses like Riverlane in quantum computing software, could pick businesses like Evernetics in synthetic biology, creating DNA, for example, or even ISI in low Earth orbit space satellites. There's a lot of interesting stuff there. But if I had to choose one for the purposes of this, I'll probably pick Mana, which is drone delivery, and using drones to deliver people's coffees and donuts and getting that last mile delivery resolved. And I think that's going to be an exciting business that we might all tangibly see in the skies before too long.
Thank you. And Nick, welcome back. The final question is around the most unique company in your portfolio today. And this, I don't think, has to be from a commercial perspective. It's something that is unique.
So I'm going to have to give you the first answer that comes to my mind. So I'm going to pick a company called Makers, which is, so they've got a great training program which takes people who don't know how to be developers at all, and over a 12-week intensive program gets them to the level where they can be get a job as a programmer, and then it goes on to get them their jobs. So what's unique about them? There are other players in that market. They're doing it in a next generation way. The course is much better, but what's really unique about them is their culture. And so it started with a really highly democratic culture, very high levels of transparency. They've backed away from this now, but for a long time, people set their own salaries in that company. And so they would write what they thought their salaries should be. They would present it to the rest of the company, and then the rest of the company would report back to them as to whether they thought that was reasonable or not. So that was great until the company was 20 or 30 people. They're about 60 now, and it started to fall apart. And we actually ended up with a strange dynamic where the junior people were paid too much and the senior people weren't paying themselves enough. And so we had to step in and sort that out. But they've remained now with this highly inclusive, highly engaged culture where everybody loves the customer, loves the product, and that is just such a productive environment for training people, so that the alumni love it because they really feel taken care of. One of them even had a Makers logo tattooed on his wrist, and the customers love it. And so customers think Google, Deloitte, Tesco, like big brands, and they love it because they step in and they say, wow, these developers that have been trained here, they've got a sense of what it is really like to work in the 21st century, highly inclusive, highly participative, highly collaborative, and therefore they'll be great employees. And indeed, they do go on. The promotion rates for Makers graduates are much faster than the competitors. I think that's a quick answer.
No, thank you. And whilst we could really go on, I'm very conscious of your time and of our guests' time. Thank you all for coming today, and I hope that the website provided some insight and background. Once again, I'm incredibly grateful for the time that Tim, Ben and Nick have offered us this morning. Hugely appreciated indeed. And do please, for those of you who are viewing, this is our first ever webinar. So we will not have got it right, and we would welcome suggestions on future topics, different formats. Please do reach out to us by email at conversations@PrimaryBid. We do have another event scheduled for early December, where we hope to explore how technology is enabling the monetization of content. And I'm sure that that'll prove to be absolutely fascinating. But with that, guests, thank you all once again.
Thank you.
And I do hope you all have a great day.
Thank you, Nick, for hosting.
Yeah, thank you, Nick, for hosting. And sorry I dropped out.
Thank you.